Welcome to Trading Airs Rundown. I'm Jim Uriel. That's Bob Iacchino, who it's odd that he's sporting a bright blue shirt. This is not like you at all. What's happened? Did you get hit in the head again?
You know, I was watching a comedian recently, and this comedian was talking about how we all, whenever somebody's in the future on a TV episode or a movie, they all are wearing the same thing. And the color basically just designated their rank. And I think it was Jerry Seinfeld said, I can't wait till we're in the future so I don't have to pick on what to wear. And I looked at my closet and I'm like, I kind of do a uniform currently. I just do black t-shirts constantly. I said, do I even own something light? And I found this. I'm like, you know what? I'm gonna surprise my friends and Jim.
It's very sunny. It's very uplifting. It's put me in a good. Actually, maybe it's not. It's what's put me in a good mood is I'm in my supplementary studio in the Florida Keys, and it's 80 and sunny outside. I've been outside all day. It's been fantastic. But anyway, that is an apology to you guys watching too, because the setup I have here isn't quite perfected yet. So if I don't sound right, like this microphone isn't even hooked up. I'm just pretending I have a microphone.
Sounds good though, buddy.
Okay, good. But anyway, we are here to talk about Goldman Sachs just put out a new research piece saying that they expect M&A activity to increase. They said significantly in 2025. I looked at that small business optimum survey that had the largest 3-month gain after the election in the history of the index. To me, it seems like something is spreading, some sort of positivity. What do you think?
I totally agree with you, and I agree with that assessment that M&A is going to do better. I will say that I looked at, because obviously a lot of this is coming from deregulation and potentially tax cuts or even rebates if Doge gets their way. That's our friend James Fishback.
I know, that's amazing.
Right, so he's getting a lot of traction on that. I think, though, I could not find a credible link between deregulation and stock performance. I found indirect links.
But it has to be a link. Intuitively, it has to be, right?
Well, no, because like everything, right, it's a three-headed monster. So, for example, right now, if economic growth and wage gains and stimulus bring us back to 7-8% inflation and bring us back to a Fed that's hiking rates, you're not going to get immediate stock market gains.
This is a good point.
So just like everything, it's just not binary. Now, there is definitely a high correlation, and I'm going to go ahead and say causation, between deregulation, tax returns, and higher tax receipts and a stronger economy. But depending on the background of all the underlying factors, it may not necessarily lead to direct stock market correlation.
And that it's so because that smacks to something that's very, very interesting, and that it's used to 100 years ago, people would look at a company and buy or sell that company. Now there's so much past investment. So the whole stock market goes up and the whole stock market goes down. Even if your situation is that you own a business and all of a sudden deregulation is making you more profitable, that doesn't necessarily equate to higher stock prices because interest rates, like you said. And I think that that's a brilliant point, and appreciate that. So something we talked to Luke Roman about yesterday, we had him on a call, and he talked about, it almost sounded like he was talking about reshoring. Like if we, yes. So do you think then the Russell can do better if tariffs are put on things and the mood here is great, optimism is through the roof? Do you think that's the play?
Yeah, from an ETF perspective, I like the S&P mid-cap ETF even more than I like the Russell. And the reason is, number one, I like the chart setup better. But number two, I like the mid-cap as the sort of preliminary source for some of what the rundown talks about, which is increased M&A. So you've got sort of
the targets, right?
Yeah. I think the mid-cap, the iShares mid-cap, the IJH, for anybody who's looking for it, I think has a more solid chart. And I think that reflects some of these sort of low-hanging fruit for M&A. And then lower in the Russell, you've got more of a mix of companies that could make it, may not. The Russell and the small and mid caps tend to outperform over the long haul in typical economic environments. And M&A is a big part of that, because if you get a stock that all of a sudden is up 300% because it's been acquired, that goes into the sort of pot of average returns.
Right. So, but we've been talking for a year that Russell needs lower rates. Does Russell really need lower rates? Probably.
No, it just needs more activity, right? It needs stable rates in order for the M&A to take hold.
Okay, and you're still mildly a bull of the market in general? Because
I'm a bull on the market. I'm just waiting for whatever is going to drive that big dip that I've been talking about coming.
Got it. All right. This is Trader Year's Rundown. I'm Jim Uriel. That's Bob Icino. We together are hosts of Trader Year's The Trader's Edge, which airs live at 3 p.m. Central Time every Wednesday. Please join us for that. The support you guys have given us has been amazing so far. We generally get probably about 8, 9, 10,000 live viewers on it. It's not even really designed to be for live consumption, but you guys have made it successful. Thank you for that.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.